Not every stock or fund is safe to build your retirement income on. In fact, most individual stocks are far too risky to be the foundation. So here's the question this video answers. How do you know which asset actually qualifies? And why do professionals keep coming back to just two, SPY and QQQ? By the end of this video, you'll have a simple three-part filter you can run in about 30 seconds. And you'll see why a couple of popular names that look like perfect candidates quietly fail the test. Names you might be holding right now. Think of the dynamic poor man's covered call the way we've built it across this series, a two-engine machine. The boat is your long leap, your foundation. The net is the weekly call you sell, and the premium it brings in finances your paycheck. But both engines sit on top of one thing, the underlying asset. If that foundation is unsound, it doesn't matter how well you manage the trade. The whole structure eventually cracks, usually at the worst possible moment. For a retiree, choosing the asset isn't a trading decision. It's a capital preservation decision. We're not asking what can make the most. We're asking what can I not afford to get wrong. So we put every candidate through three filters. Liquidity. Can I trade it cheaply and easily every single week? Trend. Does it grind higher over time? And movement. Does it move enough to actually pay rent? Miss any one of the three and the asset is out. Let's take them one at a time. First, liquidity. Here's the weekly rhythm of this strategy. Every single week, we close out the short call before it expires. That's how we avoid ever being assigned. And the moment it's closed, we sell a new one, 7 days out. Close the old, open the new, every week, all year long. Each of those trades carries a cost. The gap between the buying and the selling price, the bid-ask spread. If that spread is wide, you lose a little every single time. And over 52 weeks, that leak drains your income. On a deeply traded asset like SPY, those spreads are razor thin, just pennies. You get in and out at fair prices without fighting the market. Thin, lightly traded names are the opposite. The spread quietly taxes every trade. Liquidity is non-negotiable. But here's the catch that trips people up. Liquidity alone is not enough. Plenty of liquid assets still fail the next two tests. Second, trend. We never fight the tape. We want an asset that moves over years from the bottom left of the chart to the top right, a steady grind higher. That upward drift is what protects the boat, your long leap. If the asset trends down or just chops sideways for years, your foundation loses value faster than the rent can replace it. There's a simple way to check this, and we'll come back to it in a minute. But the principle is this: we only rent out properties that are increasing in value over time. Third, movement. The asset has to actually move, but the steady kind of move, not the violent one. Here's why it matters. The rent you collect comes from an option's time value, and time value only exists when the market expects the asset to move. A sleepy, low volatility fund barely moves, so its options are cheap and there's almost no rent to collect. A broad index like SPY typically covers a lot of ground in a normal year, easily more than 20% of round-trip movement. And that's plenty of fuel. But a meme stock moves far too much, in gaps and lurches, and that sinks the boat. SPY and QQQ sit right in the sweet spot. Enough movement to pay you, not so much that it threatens your capital. Now, how much rent that actually turns into each week, in real dollars, is exactly what Video 8 was about. Go back and watch it. The monthly income a single position can sustain is more than most people expect. Here, we're only choosing the asset. So why do SPY and QQQ pass every test? They're not single companies. They're baskets of hundreds of the largest companies in America. That means no single earnings miss, no CEO scandal, no bankruptcy can wipe you out. And they're self-cleansing. When a company weakens, it's quietly dropped from the index and replaced by a stronger one. You never have to manage that. It happens automatically. That's why we say SPY and QQQ cannot go to zero. Add the deepest options market in the world, and you have the closest thing to a protected foundation for your retirement income. And in the very unlikely event things ever did go badly wrong, we're not defenseless. We have a stop rule for exactly that, the one we covered back in video 7. Here's the shortcut I promised. Before you trust any data, open a 5-year chart of the asset and zoom out. Ask one question. Does the price move clearly from the bottom left to the top right? If yes, it's a candidate. If the chart looks like a mountain range, peaks and valleys going nowhere, or a jagged heart monitor, walk away. Data can be massaged. Earnings can be dressed up. A 5-year trend cannot be faked. 30 seconds. One look. Look at SPY and QQQ up on the right. Years of bottom left to top right. Yes, there's a bump in the middle, back in 2022. But a short-term dip like that doesn't frighten us. That's the whole reason we run a system with rules, instead of guessing. Now let me show you 2 assets that look tempting and fail this test. And they're probably the 2 you're already wondering about. First, small cap stocks, the Russell 2000, the fund you'll see on screen as IWM. It's a fair question, because small caps are an index, they're diversified, and they're extremely liquid. They sail through criterion 1. But run the 5-year chart, and the trend gets shaky. Small caps aren't in free fall, but look at what they did. They hit a peak, then went basically sideways for the better part of 4 years, round-tripping up and down, before finally breaking higher only in the last year or so. Small companies are more sensitive to interest rates and to the economic cycle, so their flat spells run longer and their declines run deeper. Liquid? Absolutely. But a foundation that goes nowhere for years leaves the boat with no wind. That is the whole point of the second filter. Liquidity gets you in the door, but a reliable uptrend is what keeps you alive. Second, gold, the fund you'll see on screen as GLD. Gold gets recommended a lot as a safe foundation, and you can see why. It's liquid, and it's had some spectacular runs. But here's the problem, and it's the one you may already sense. Gold moves in long regimes. It can rip higher for a couple of years, then go flat, or decline for years. One stretch lost roughly 45% of its value, and took nearly a decade to fully recover. And you don't have to look back far for that volatility. Just recently, gold went parabolic to a record high, and then turned around and put in one of its worst months in nearly 20 years, giving back a large chunk of that gain in a matter of weeks. And unlike a stock index, gold has no growing businesses underneath it, nothing that compounds it upward over time. It isn't self-cleansing. It's driven by cycles of fear and greed, and by interest rates. So it can pass the trend test in one decade and fail it badly in the next. For a retiree who needs the foundation to hold every year, that's too unreliable. Gold can be a hedge. It is not a foundation for this strategy. IWM and gold are the respectable near misses. Most disqualified assets are more obvious. High volatility with no direction, meme stocks, offer huge premiums, but that's hazard pay for a foundation that can collapse under you. Thin, low-volume names, the spread eats your income on every roll. In binary event risk, individual stocks that can gap 10 or 20% overnight on a single earnings report or an FDA decision. One bad gap can erase months of collected rent. Remember, we're collecting steady income. We are not betting on headlines. Is there ever an exception? Yes. A few of the largest, highest quality companies, names like Apple, Microsoft, or Amazon, can work as a foundation. But they demand real vigilance. Each one still reports earnings 4 times a year, and any of those can gap the stock overnight. And each carries single company risk that an index simply does not. So honestly, if you're a retiree, my advice is simple. Stay with SPY and QQQ. Let the system run quietly in the background and spend your energy on what actually matters. Your family, your time, the life you retired to enjoy. So there is the filter. Liquidity. Can I trade it cheaply every week? Trend. Does it grind higher over the years? Movement. Does it move enough to pay rent, the steady way? SPY and QQQ pass all three. Small caps and gold don't. And most individual stocks don't come close. For a retiree, asset selection is a capital preservation decision first. SPY and QQQ cannot go to zero. They cannot be acquired. They cannot miss earnings. And if the market ever does turn hard against us, our 25% stop loss on the long leap is the safety net that caps the downside. Get the foundation right, and everything else in this system gets easier. And next video, once you've picked your asset, how do you choose the right long leap, the boat itself? There's one number that quietly controls almost everything about it, and a simple rule for getting it right. That's video 10. If this helped, subscribe and hit the bell so you don't miss it. And if you've got a question, drop it in the comments. I read every one. One last note, everything here is educational only, not financial advice, and options carry real risk. I'll see you in the next one.